Hey, we're going to get rolling in here today, and instead of focusing on the grain markets, we want to take a look at a few different things. And the one thing we want to take a look at right now is inflation rate, and the reason why is the Fed this week. Tomorrow they're going to increase interest rates, and it's widely expected that they're going to increase them by 75 basis points. And why they are increasing interest rates is because inflation is really out of control. As you can see, the inflation rate right now is the highest since the early 1980s. And at that point, we did have runaway inflation, and then interest rates went sharply higher. So the Fed really believes the best way to slow down inflation is really to raise interest rates. So right now, we're going to look at a 10-year note. This is commonly looked at on businesses. You can see where that rate has jumped from a 0.5% here in 2020 following the whole COVID outbreak, and now up around 3%, which is the highest level in the last 8-10 years. And you go back to since it's been traded since 1990, we're still well below those levels. So this interest rate has ways to work up. We believe the interest rate you really should look at, though, from a consumer standpoint, is a 30-year mortgage rate. And when you look at this chart right now, the thing that stands out to us the most is that the 30-year mortgage rate is historically above the rate of inflation. Go back to the 1980s, that 30-year mortgage rate went above 17%. Now, we think that the Fed's going to be relatively slow. I know it's going to be a big jump in here this week to continue to increase interest rates. And the reason why is our federal deficit is too high at $30 trillion. We just cannot increase interest rates too much, else our national debt just isn't serviceable. But why we like focusing on the 30-year mortgage rate is this is what affects most consumers. So when you look at some markets in here that have been relatively hot, people say, well, ag is good, energies are good, and so is real estate. Well, our thinking on the real estate side right now is that the housing market has probably peaked out and we need to correct back. And this is a chart in front of us right now, looking at from 1 year ago, July 2021, to today at 2022. And on the top line, we have a 30-year mortgage at 3%. It was a year ago. Now that same 30-year mortgage is at 5.5%. If we look at that blue line in there right now, that's at $50,000. And that's on both of them, as we assume here that the consumer has $50,000 to put on the house. So a year ago, they bought a $500,000 home. They had $50,000 down. They had a total mortgage at $450,000 at 3%. Their monthly payment was just shy of $1,900. Well, now as we fast forward to today, and we have interest rates at 5.5%, if that homeowner has that same $50,000 to put down and has a monthly budget of $1,900, they need to keep their monthly payment at that level. That same house has got to come down to $385,000. The real estate market has been slow in coming down in here, but it's this higher interest rate right now that is probably going to peak this market out and bring us back down. How far we fall, that can be debated, but just looking by these numbers in here right now, the interest rate on the 30-year mortgage from 3% up to 5.5% can lead to a 20% correction in the real estate market. The other place where consumers are getting squeezed is at the gas pump. And on this chart in front of us, and I don't want to get political, but you can see during the Trump administration and even the latter part of the Obama administration, the national average gas price really stayed between $2 and $3. Recently, it's between $4 and $5. So how does this affect the consumer? Well, in front of us right now, we figure the average suburban family uses about 200 gallons of gasoline per month. I mean, it takes a lot of gas going to baseball and soccer and school events and even the county fair season right now. But the average consumer uses about 200 gallons per month. Well, when we had gas prices at $2.50 a gallon, their budget was about $500 a month. Now the average gas price closer to $4.50, that's $900 a month. We're getting to a point in here right now where consumer budgets are getting squeezed. That's where you got to be a bit concerned when we start looking at this real estate market where that's sitting at. Next week, we'll get back to the grains, but we just thought this week, especially with the interest rate increase coming out in here, we wanted to take a step back and take a look at that. Have a great day.